Is TLT, the long-term bonds ETF, near a bottom? Also, how high can a 10-year yield go before the market forces the Fed's hand into making a policy move? I will include links to my previous bond videos in case you missed them and you want to get caught up on what's going on. Alright, let's go ahead and dive right in. Let's begin by looking at TLT on the weekly view. The relative strength index is currently at 25.75. This is the second lowest level I could find in TLT's almost 20-year history. The lowest point is 25.1 in May of 2006. Statistically speaking, the probability is high that we are near a short-term bottom. Let's look for further clues. The 137-138 price area is the 61.8% Fibonacci retracement level, and the $135 price area is horizontal support. There is also horizontal support at the $130 area. I don't expect prices to go lower than that over the next 2 weeks, since TLT is already so oversold. I think if the price reaches $130 to $135 price in the next 2 weeks, then it could be a good short-term risk to reward trade. I would be looking for high volume and for lower prices to be rejected off of the bottom before the end of the week in which it happens. Next, let's look at speculative positions in the 30-year bond futures. As we can see in this chart, the rates have been rocketing higher, and yet the short interest is still near record highs. Short interest actually rose from the previous week as rates went up. Based on this, I think the market knows that it can force the Fed's hand into putting a cap on higher, longer dated bond yields by simply selling bonds to the point that the market breaks or the Fed panics into policy action. If the market breaks, then it will be self-evident with falling stock prices and the Fed will come to the rescue. But if the market stays choppy with sideways price action and yields continue to rise, then we will start to hear the Fed talking about their openness to controlling the long end of the yield curve if necessary. The jawboning would only be a short-term solution in lowering the yields because the market will end up forcing the Fed to act anyways. If you watched Jay Powell's recent press conference, you could actually feel his nervousness. The next question to answer then is, at what point will the Fed be forced to act? To answer this, let's look at the all-important chart of the 10-year yield. Looking at the weekly view, we can see that the 10-year yield has stayed within a well-defined long-term downtrend of lower yields. Looking at the current upswing, it looks like rates could continue higher over the next few months towards 2%. With rates currently above the 1.5% mark, we can see growth stocks like Tesla struggling, and I would expect more of the same should rates continue higher. I think the Fed will be at the very least talking about yield curve control if 10-year yield goes close to 2%. A level of 2.5% or higher means that the Fed has likely lost control of the bond market and will be forced into policy action. Timing an entry into TLT just before the Fed action could be very profitable, especially if the huge short position in the long-term bonds is still in place at that future time. I know that some of you may be looking at this chart and wondering why this is such a big deal, since 2% or 2.5% is still historically very low for yields. I totally agree, but the debt loads of governments, corporations, and individuals is much higher than in the previous upcycle in yields. Keeping this in mind while taking another look at this chart now makes more sense to the downward trend. Each down cycle in yields goes lower to create borrowing demand, and each upcycle generally trends lower than the previous one because the higher debt loads can't support higher debt servicing costs. In summary, I think that if TLT price falls to around $130 to $135 within the next week or two, it could be a good risk to reward short-term trade. I think that the 10-year yield may go up towards 2%, but at that point, the Fed will start talking about yield curve control to talk it down. A yield of 2.5% or higher is a recipe for trouble in the markets that will force the Fed into yield curve control. Thanks again for watching. See you all in the next video.